For financial professionals, an inherent tension exists at the end of every reporting period. The net profit shown on a company's financial statements rarely aligns with the taxable income calculated for the government. Accounting Standard 22 exists to reconcile these two competing realities. Accounting income is the net profit reported on the profit and loss statement before any tax deductions. It is calculated using the matching principle, aligning revenues with the expenses incurred to generate them in a specific period. Taxable income is the profit determined strictly by the statutes of the tax code, which often disregards accounting timelines in favor of immediate policy goals or revenue collection. The objective of AS-22 is to match the tax expense against the accounting revenue earned in the current period, entirely independent of when the tax authority actually demands the cash. To bridge the gap between these timelines, AS-22 uses a specific equation. Total tax expense is the sum of current tax and deferred tax. Current tax is the exact, immediate cash liability payable to the taxation authorities based on the taxable income for that specific period. Deferred tax is the accounting mechanism used to record the tax effect of the differences between the two ledgers that will eventually resolve in the future. Without this standard, strict adherence to tax law timing would distort a company's reported financial performance. Deferred tax bends the cash-based reality of the tax code to fit the accrued reality of the accounting timeline. To calculate the correct deferred tax, we first have to diagnose why the accounting and tax ledgers diverged. Every financial transaction that causes a difference must be evaluated based on a single criterion, its future reversibility. Some items originate in one period and will never reverse. These are classified as permanent differences. Consider a penalty paid for late taxes. It is an expense on the accounting ledger, but the tax code strictly disallows it as a deduction. Because this difference never reconciles, it alters absolute tax liability permanently, generating zero deferred tax. Timing differences are the targets of AS-22. These divergences originate in the current period, but mathematically guarantee reversal in a subsequent period. For example, the tax code might allow a company to fully expense a piece of machinery in year one to incentivize investment. On the accounting ledger, that same machine is depreciated slowly over its 5-year useful life. Permanent differences alter a company's total wealth. Timing differences merely shift the schedule of when taxes are paid. The deferred tax mechanism exists solely to track and record that displaced obligation. To observe the mathematical inevitability of this reversal, we can examine Omega Limited, a firm executing a 3-year contract. For its financial statements, Omega uses the percentage of completion method, recognizing revenue smoothly over the 3 years. For its tax filings, it uses the completed contract method, delaying all revenue recognition until the project finishes. This chart shows a 3-year comparison of Omega's income. In year 1, Omega reports $11 million in accounting income, but the tax code only recognizes $7 million. This creates a $4 million timing difference. Because Omega today, but that tax will eventually be due. Applying an enacted 35% tax rate to the $4 million gap creates a deferred tax liability of $1.4 million. In year 2, the reversal begins. Taxable income climbs to $18 million, exceeding the accounting income of $16 million. The company now pays the tax it delayed, reducing the deferred tax liability balance by $700,000. By year 3, the project concludes. Taxable income hits $23 million against accounting income of $21 million. The final $2 million difference reverses, and the liability balance drops exactly to zero. Section 4.5 of AS-22 dictates that these balances must be calculated using the tax rates enacted by the balance sheet date. Furthermore, deferred tax assets and liabilities must never be discounted to their present value. Over 3 years, both methods record identical total revenue, $48 million. The deferred tax liability operates as a temporary mathematical staging area, ensuring the timing difference resolves without altering the total economic reality. The mechanism operates in reverse when a timing difference forces a company to pay more tax today, generating a future tax benefit. This creates a deferred tax asset. Take the case of PQR Limited, which sustains a $200,000 loss in its first year, generating a carry-forward tax loss. With a 40% tax rate, PQR mathematically has an $80,000 deferred tax asset. However, AS-22 halts the automatic recognition of this asset. A strict prudence constraint dictates whether it can actually be placed on the balance sheet. The baseline rule requires a company to demonstrate reasonable certainty that it will generate enough future taxable income to realize the benefit of the asset. Because PQR's asset stems from carry-forward losses, the standard elevates the barrier significantly. The company must prove virtual certainty, supported by convincing evidence, that future profits will materialize. Virtual certainty is an objective matter of fact. Business plans, optimistic sales projections, or positive ratings from a credit agency fail to meet this threshold. To qualify as convincing evidence, the proof must be concrete at the reporting date, such as a profitable, binding export order, where cancellation would trigger severe financial penalties for the defaulting party. AS-22 enforces a strict asymmetry. It assumes future liabilities are inevitable, but treats future benefits with intense skepticism. A deferred tax asset remains unrecognized until facts guarantee its realization. The status of these tax accounts is continuously dynamic. At every balance sheet date, a company must reassess any unrecognized deferred tax assets. If economic conditions shift and future taxable income achieves virtual certainty, an asset blocked in previous periods can be recognized and recorded. This balance sheet layout demonstrates the strict presentation rules of the standard. Deferred tax assets and liabilities must be placed under a separate heading, explicitly segregated from current operational assets and liabilities. The final consideration is whether a company can offset its deferred tax assets against its deferred tax liabilities to report a single, simplified number. Offsetting is permitted only if two strict criteria are met. First, the enterprise must possess a legally enforceable right to set off the recognized amounts against current tax. Second, both the deferred assets and liabilities must relate to income taxes levied by the exact same governing taxation authority. Accounting Standard 22 is a rigorous mathematical bridge. It fully accepts the cash-based reality of the tax code while forcing those future tax effects to align precisely with the period in which the revenue was actually earned.